To cloud. Hey guys, it's Friday, the last day of July, 1 o'clock. And this is a really, really interesting market. Let me share my screen. Past performance, not indicative of future returns. And I'm going to go through a few items to think about for next week. And then some of the earnings that we saw. I know everybody cares about Amazon, so of course I'm going to do Amazon. You know how much I love energy, so obviously I'm going to go through the companies that reported energy this morning, Exxon, Chevron, and Phillips. And then I think I might have one other item that I was going to chat on a little bit. Yeah, Intel. Oh, wow, what a disaster. But let's just take a look at it. For context, right now, this is what we're seeing today, which is a mixed bag. Amazon is dragging everything positively up. And I'd kind of been staying out of it, even though it gotten clobbered quite a bit. So I'm actually neutral on Amazon. I'm going to show you what I saw despite what's being done. And actually, if anything, if it keeps rallying too much over this, because this actually represents that 2,800 level, it's right on top. It's like maybe 27 and change, but it's right on top of the 2,800 level where I kind of started to get bearish over that level. I was bearish at 3,600, which is way higher than it is right now. But if it tries to peak up over there, it does become a good short again. I'm going to show you why. Because this was not nearly remotely as good of a quarter as everybody that's rallying it up suggests it is. Here is what the indices look like this morning. Everything is going straight up to the moon. And I kind of thought this might happen as much as everybody else thought it might happen. But my reason is really because month end, sometimes you get window dressing, and we are finishing up the summer next month. A lot of people are going on vacation, and we just had a ton of short pressure at the beginning of month on all of these names. And I'm going to go through that. Excuse me, I'm going to go through that a little bit as well. Hey, it's live show, do the best I can. When I go to, but I'm going to go through why I thought there was a lot of short pressure in this marketplace as I go through some of what I saw here. So let's kind of take a look at what I'm seeing on the macro front though first. You know, everything is coming in approximately what people expected anyways. And next week, there's PMI on Monday, which is what the manufacturers are seeing as relates to whether or not industrial demand or manufacturing demand is doing well or not. Now, I care on that, but I don't know if the market necessarily cares on that, to be fair, because we are in the middle of the summer and we still don't yet have that stimulus package. People keep forgetting about the stimulus package, but it was passed and it is coming. Usually in the fourth quarter is what everybody was saying as soon as it was passed that it would take for the municipalities to flow that on through. So realize that I'm interested in this number personally a lot, but I'm early probably, and I'll be watching it. Otherwise, there isn't a lot next week, which does this, given how this market's behaving, I mean, it really could go either way. Most of the crazy earnings reports of the big cap names have come out. You still have some big cap stuff to report, such as Disney, et cetera. But a lot of earnings is done at this point. Let me show you, this was this week, but you know, probably missed like a bunch of names because there's just so many that came out all at once. And these days, the data feeds are just not doing a good job of keeping up with when people are reporting earnings. This is what I'm seeing for next week. There are a couple names that I'm very much so watching. I need to understand what's going on with Caterpillar. There's a couple more airlines. I will say that all of the airlines have been reporting crazy good quarters, which allows them to finally pay back some of the money they took from all of us, the citizens of the United States. I might have some Canadians that watch us from time to time. So it's really weird what the market's doing versus what other things are going on. Albemarle, that is one I've been bullish, and I feel bad that I didn't repound the table on it when it was under 200 because I've been taking a positive stance. It will probably do fantastically. I mentioned it again when Tesla reported earnings, and I think it was around the 220 level. It's since risen another 20 points. And that's because even Elon was like, we need more people to go into lithium. That is like a license to print money right now. Albemarle is the largest cap name that does lithium in the United States. They've got facilities in Nevada, which is actually pretty close to a bunch of train rail lines that do allow them to then service the auto manufacturers in particular that are going to need that lithium to create the batteries, to create the cars, right? So that's like a thing. Albemarle will report. To be fair, because this market is so skittish, I have mixed feelings about how to think about it. Additionally, Consol, which I have talked about a lot, you guys know how bullish I am on ticker CEIX, Consol Energy, will report on Wednesday. And I have no idea which way the market will take it on earnings, but I will say that even though BTU and Arch Coal are both trading off, that is a mistake in the marketplace to also throw Consol Energy in with it, because the whole point of why Arch and BTU are trading off is because they can't get the thermal coal from the center of the country down to where you could then ship it out. Consol doesn't have that problem. Again, I went over that yesterday, and I just want to remind you guys, its thermal coal is being done out of these areas over here to the right. And essentially, unlike the middle part of the US, they actually specifically, when coal started to get thrashed because we were going to move towards a greener energy situation, but when coal started to get thrashed, they invested in the rails so that they could then ship it out, because they knew that their business, if they was the CEO that was put in to turn the company around, they knew that that business was only going to survive if it started to become an exporter of coal. And that's what they built it for. So the only possible thing that they could say that might be awkward is that they pre-sold too much coal, or that they're having some issues there, but it's a very low probability. Consol, if you're going to do it, it's tough because the earnings reactions have been so crazy. I prefer people own the stock versus doing anything too funky in the options because of the liquidity associated with Consol. But it's going to be fine for probably at least a year, given what I heard this morning from Exxon and Chevron. So let's do those first, and then we'll do the good and then the bad and the ugly. Exxon, Mobil, and Chevron. I just want to show you, Exxon reported at 9:30, Chevron came out at 11, and then Phillips just finished up its call 2 seconds ago. And I have no idea why anyone thinks that GDP is even going to matter for these guys for the foreseeable future, meaning at least the next 3 quarters, because I think there's a disconnect between how macro people are thinking about energy and what's actually happening, which is really bizarre to me. The reason that we have to raise interest rates is because there's some desire to slow down the economy, because the energy situation is out of control on the tightness in supply, meaning that all that's going to happen if we didn't try to do that is that you would have this massive soaking up of demand. And so this is a commodities driven situation that we're seeing here as relates to all of the things, because quite frankly, how do I say this? There would be no need to raise interest rates if energy wasn't so crazy high. Okay, there's no other way to say it, because why would you do that? You would want the economy to do well. It's not like we just try to mess with the economy. So it's really inflation and stability of pricing that is driving all this interest rates, not the other way around. And what's the only thing that's going to happen is that the U.S. will continue to become the lower and lower cost producer. We are the low cost producer, period, of the entire energy complex right now. And that is because we actually have it. I don't know another way to say it. Other people don't have it. And that is kind of the real truth of it. I mean, even if they have it, some of them either can't get it out of the ground, or alternatively, they can't get it transported. And that's all that these companies are going to continue to say for the next 2 quarters, because it is not Amazon Prime. You do not just dial up and magically it appears on your doorstep. You actually have to stick it in something or on something and then allow it to move to the place where it needs to go. So ExxonMobil basically can sell it for whatever it wants, essentially, it will sell it for whatever the market prices it as, because if it tries to do anything different, all it's going to do is continue to drive up the price of oil. So for example, if they suddenly sold it to me for $44 a barrel, which is now it's break even. It used to be $60 a barrel, but because they've paid down so much debt, it's now cheaper for them to make oil than it's ever been before. But if they suddenly sold it to me, okay, oil's at $95, $98 per barrel, but if they suddenly sold it to me for 60 and I burnt it up, all that's going to happen is the price of oil is going to go up, because there's going to be less for them to sell to everybody that's willing to buy it at 90 something dollars a barrel. So it's like this dynamic is just so misunderstood and it can't sustain forever. But you don't even have to worry about that. All you have to realize is that in the United States, for the US oil producers, this is very different if you're looking at some of the overseas producers. That said, I don't cover the overseas producers, so I'm not going to say anything there. But for the US oil producers, right, they are actually going to have an increasingly low break even, not because it's not more expensive to pull it out of the ground, but simply because their cost of capital is cheaper. They are paying down debt. And this is what I want to show you. This is what they did in revenue, okay? 37 to 68 year over year. And that's despite the fact that their chemicals business is now doing a little bit lower. It's still profitable. It's still doing fine. The chemicals business is basically taking oil and turning it into PVC pipe, right? And PVC pipe is a little bit weak right now because housing is not doing what it was doing before, even though people are definitely still spending on plumbing, et cetera, et cetera, et cetera. So it's a little bit more muted. That business is not the biggest part of their business, but it's there. But this actually revenue growth understates how much money they're making hand over fist because the demand for oil is there, okay? And then this right here is their debt expense, which they are just paying down. It's just decreasing. It's small. There's a couple other places where it shows up, but I don't know another way to show it to you. So I'm just using this number right here, this 185 to 129. There's a couple other ways to show this on how it adjusts their capital expense, but they report, give a girl a break. And then net income is just really showing all of the benefits of what is happening right now. And you can see they have a massive income tax benefit associated with some of the things that are going on there. So ExxonMobil, it's not my favorite name within energy because I truly, truly, truly believe that the onshore guys are going to be so much better. And that has to do with what I saw in Chevron. Chevron also, this is their earnings, by the way, you can kind of see it's crazy good. They also have a chemicals business. But if you look here in this tiny, tiny box, this is actually more what their energy business is doing. So you can see that that is crazy positive, 3 billion to 11 billion, okay, in revenue this quarter. I mean, it's just really, really solid, ridiculous earnings. Upstream business, that's from exploration and production, okay? Downstream, that is some of the refinement and some of the other like transport stuff. And the thing that they told me on these calls, as well as Phillips, that made me say, oh my gosh, the onshore guys are going to make even more money is because right now, you can't like even, so everybody that's, and this came from Phillips, everybody that's refining oil, oh, and Phillips did crazy good, by the way, like the numbers on Phillips, which means MRO next week will also do crazy good. The stocks aren't reacting for some reason relative to how good the quarters are. But the point is that right now, refining capacity, the ability to actually turn oil into what you need it to be, it's not great right now. And that has to do with how much capacity was taken off by Belarus, the Ukraine, and Russia. People forget that those two countries also matter, Ukraine and Belarus, not just Russia. And conflict does not bode well for actually doing business. That is what it is. But the fact is you also can't pipe it in that well, even if you start projects and try to bring it in from the Middle East. And that's just because there's only so much piping capacity. That was the whole point of a couple of discussions that we had in some of the February stuff that we did. If you're unfamiliar with that, go back and look on my YouTube, on my videos in February. I talk about it a lot. So it has to be brought in the format of liquefied natural gas, LNG, or it has to be coal, okay? It has to be something that doesn't go through a pipeline right now because there's no way to additionally put more capacity into the pipeline in any meaningful way versus the producers that already have that capacity. So that tells me that the onshore guys that are sending liquefied natural gas over, to the extent that the terminals, the pipelines, KMI, Williams, et cetera, to the extent that they can actually turn it into liquefied natural gas and get it over, those guys are all going to do fabulous. And then my honeypot coal company, Consol, is going to do great because there's an infrastructure issue. It's not even an energy issue by itself. It's actually an energy infrastructure issue as well. So that's the whole, that's a multi-quarter situation as they both try to find more energy reserves and get this infrastructure situation under control. Now, the one thing they did say that I did not know was that the average rig, so when you look at rig counts, it's a little deceiving, but the average rig for them, ExxonMobil and Chevron, were saying something to this nature, can actually pull more energy out of the ground to the tune of like one rig does twice as much as it might have done like 5 years ago or since the last cycle, something like that. So the rig count is a little deceiving, but that's what I heard. That's the story. You know, there you go. Okay, so let's talk about Amazon, all right? Oh my gosh, the love for Amazon is next level out there. It's not that I would necessarily, like, you know, I was very clear. It's like, I'm uncomfortable shorting it here, which was a price of, you know, 2,200 or 2,100 relative to the old pricing when it was at 106, 108 or whatever it was. So it's like, I'm really uncomfortable shorting it here. So it kind of is what it is. I'm staying out ski, but I'm not really thrilled about this earnings report like everybody else was, because everybody's like, oh, AWS, so wonderful. So hold on, I'm missing a slide here. Where did I put the earnings? Okay, so here's the earnings of Amazon. Okay. They did not sell more product. I don't really know another way to say it. They did not sell more product. Okay. The stores are actually not selling more product. They are making it on service sales, which is absolutely advertisement sales and the AWS business. That's what this uptick is. They are not selling more product. I wish people would stop. It's driving me bonkers. But I want you to really understand what is the nature of this ad revenue that everybody is so excited about, okay? It is not quite the same as like when someone gives ad revenue to like Netflix, or when someone gives ad revenue to like Google, which is what everybody's trying to compare it to. The ad sales component is someone that is on the platform of Amazon trying to sell their product. So what it essentially is them sticking it to the retailer. That's what it actually is, okay? So they're sticking it to the retailer, but they're still losing $2 billion, for God's sakes. Goodness sakes, sorry for that, guys. So I just really want to like caution people when they're hearing these like snippets that everybody's so excited about, what that actually is. Now, is that good? Is that bad? It's hard to actually articulate this fully, because what I want you to understand, and what I talked about last quarter and the quarter before, is yes, they did raise the price of Prime, but I told you guys last quarter that they, actually, I think I told you guys this in the February quarter, that they raised it, but energy prices had spiked way more than they would have ever been able to compensate for in the price of the Prime increase. So like, for example, fulfillment, which is essentially the fuel price from 2 quarters ago when they first raised it, was already up 30%, and they raised the Amazon Prime thing by 30%. Subsequent to that, fulfillment has continued to increase a lot, not a little. Even in just this quarter, you're seeing like, quick math on that, you know, I don't know why I can't do the math, 20%, something, 25% increase. Sorry for all the Asian people that are good at math, but you're still seeing this massive increase in fulfillment, which is essentially your fuel cost, okay? And then the labor cost as well, right? So these things are going up. So if they're not, you know, yes, great, you're charging your sellers more on what you're calling advertisement. That should happen anyways, because the platform is actually adding more value. I get it, but you're not compensating for this change. And then we're not necessarily seeing in this world some sort of reduction in the price of energy, right? It might, all I've ever said is that it might stabilize, and that would stop inflation, not that the price of oil and gas would come down. So realize that that's a real oddity in the way people are talking about Amazon right now. So that drives me a little bonkers, I'm not gonna lie. And then the other thing that I heard said right away about Amazon is that Amazon Web Services is just doing so amazingly that it can continue to support the rest of the business in ways that, okay, look, maybe is what I'm gonna say, because it is in fact growing quite a lot. If you look at these numbers, these are fantastic growth. This is really, truly fantastic growth, I'm not gonna lie, but realize that 42% of Amazon Web Services operating income, like if you add these two numbers up and then divide it by what AWS made, that's how much you're penalizing AWS for the retail business. They got to fix that is all I'm saying. They got to fix that. And that's my 2 cents on Amazon. That's why if like, do I want to like short it today? No, you got to get out of the way of momentum. I'm no fool. Do you know what I'm saying? But like at some point, you know, and what, okay, this is the deal. In order for Amazon to do well, back to school has to do something it's never done before. Okay. Maybe because we really didn't have a back to school last year, but we're talking about, so they're reporting this is June. So then it's going to be the summer months. So this actually is going to be June, July, August, which August would be your back to school. And that would be the next quarter that would be reported in November. And then usually because of the way they report, you do get that Cyber Monday or whatever it is, like, you know, that you can then like figure out if they did really well on the first part of Christmas. But it's not like, I mean, just realize that it is like aggressive right now to be long Amazon from this point of the rally. We shall see. If you're a day trader, you know, and that's a great way from your promo, my very dear friend. You guys on the day trading side, we have a great show first thing in the morning that you guys should take a look at. Go to gurula.com and check us out there, gurula.net. And check us out there. And then the last thing I'm going to talk about before I end my rant today is Intel. I mean, look, I was wrong. I'm just going to have to admit I was wrong. Intel was a bit of a hot mess. I'm not going to lie. They cited that it was because of desktop and notebook. So if you've got positions in Best Buy, you got to be really careful, even though consumer, I think it's going to, consumer in theory did better in June, consumer electronics, but this was just really bad. And then data center and AI was what surprised everyone. And one analyst came out and was like, yo, why didn't you pre-announce? You know what I'm saying? Which is a real question. And they said some things, and I can't imagine that it was to the satisfaction of anyone. So I can't tell what exactly is going on here other than they are losing market share for sure, because no one had this issue in data center and AI, which tells you that data center and AI is out there losing share. There's no other way to say it. Now, whether or not I actually think that for the next quarter, what he should do is just kitchen sink the year, which means like throw in everything that he could possibly do in the way of accounting to, you know, get the business a certain way so that you have a shot at 2023. But this is at best dead money for the rest of the year. I'll watch it and monitor it, but Intel, do not try to pick it up. Also, I think it's really critical that you don't necessarily try to draw Intel into the rest of the semi space and what's going on there, because right now, even within semis, as much as I felt one way before, I do not feel that way any longer. There really are specific strategies that are benefiting in this marketplace, and there are strategies that are not. And that's what we're really seeing. And with that, I'll hit the pause button. Are there any questions? David, you're less shy, so I know you you probably go first.
Yeah, hey May, I'll jump in. Great show. Are you saying coal infrastructure, they can't get it to the East Coast?
Yeah, because like the trains, so it's interesting because it's called the thing you want to Google, so that you should never just take me for my word at anything. That's why I try to make sure there's plenty of slides and citations for everyone. But the thing that you want to look up is the Powder River Basin rails, okay? Powder River Basin is where both Arch and BTU have their coal. That's where they'd have to ship it out of. And you'll see that a bunch of rail companies originally were like, oh, we're going to reinvest and improve it. Even Berkshire Hathaway actually was looking at this region for BNSF, since they own that rail line. And they were like, oh, I don't think we should do that, because I think that the world is coming off of coal. Do you know what I mean? And specifically the United States coming off coal. So they didn't reinvest in that rail line. So all of the holdup, if you look at like the CSX has done a little bit better for sure. And each one of the rail lines has to do their own deal. Like they each have their own strategy. It's trying to make this simpler than versus my usual long rants, but each of them has their own strategy to try to like improve the speed at which the trains go, and then the volume at which the trains go. CSX by far has done the best, and then the other two are just working on it, for lack of a better way to describe it. But it's a bit of a disaster. It's an infrastructure issue as relates to those two companies. Now, if they can figure out a way to get it to where it needs to go? Will they get amazing pricing? Yeah, both of them show pricing that is fantastic. They just don't show volume that's fantastic and allowing them to even blossom further, for lack of a better way to say it. Console, I am arguing will not have the same issues that Arch and BTU are having. That's why I'm more bullish console, but we shall see. I mean, they report on Wednesday. Ouch. The one thing I would say that is a weird legislation that oftentimes goes ignored is that for the first time, we started to see a little bit of a change on passenger rail versus industrial rail. In the US is very different from Europe. Passenger rail does not have the right of way to move stuff, goods and services from one place to another. But then some of the legislation changed such that now passenger rail does have the right of way. And so that's a little freaky deaky for the East Coast in particular. So we'll kind of see, but given what I saw in CSX and the fact that they still had coal volumes up 25%, which is closer to what I would have expected, my suspicion is that console's going to do great. I don't know another way to say it.
So you're saying a passenger train can carry an industrial load?
No. It used, I don't know if you like, actually, I do know this because you used to live in the East Coast, but I don't know if you've ever taken the train from like DC to New York. And
Okay.
a lot of people take the train because it is actually a wash between taking a train to DC or taking a flight. And a lot of times you'll be sitting there for a while and you're like, why? In Europe, that would never happen. And that's because we do have this archaic legislation that gives commercial the right of way on a given piece of track that's laid down. Now so that's what that was all about. And some of that has moved in certain places. I have on my to-do list a little bit more work to do on it, but that's the one thing that might actually change how much you can actually pull.
Right. You've been in CEIX since around 50.
No, I've been in since 32. Sorry, guys.
Well, it's now 60. So
Yeah.
Brilliant. Okay, oil companies. So I think I'm hearing you saying they're using their income, which is really large, right? To pay down
crazy.
pay down debt and issue dividends versus explore for new oil, right?
No, they're doing like $1 billion more in oil exploration than even 2019. So because I mean, it's just so much cash. I don't know another way to say it. It's like so much cash. Like, okay, so oh my gosh, it's so crazy cool, like in some ways, but it's so crazy horrible because all of us are living it in a different way, So essentially, yes, they're paying down debt. Yes, they have actually increased CapEx, but they can only do it in certain ways that are thoughtful, for lack of a better way to describe it, because you still have to find it before you don't just drill arbitrarily, let's just drill a hole here. No, you got to actually find it first, right? So, and then some projects have a higher potentiality to like hit and some don't, right? So you kind of like really have to be thoughtful. Still, you're still running a company. Okay, but the other crazy thing that you didn't name, but I know you know for sure, is that they're buying back stock, because even if they're giving more dividend, if they buy back enough stock, net, they're not necessarily spending, well, they are, because they're never going to buy back more. But like, so for example, I think the plan is to buy back about 1% of stock a year for either Chevron and Exxon. I can't remember, but it's approximately the same because they're both making tons of money. So they'll buy back essentially the equivalent of the short interest right now, more or less, at least. Yeah, that's definitely Chevron. So they'll buy back like 15 million shares. The short interest is 19 million shares, right? And so it's like, crazy, for lack of a better way to say it.
That's cool. So if you're saying they're exploring for more oil, I mean, near term probably wouldn't affect it, but longer term wouldn't that?
That's how they have to think about it. Yeah. But it's not like they're not increasing production, especially in the US. Like the US producers are increasing production far faster than any other geography.
Right.
Well, we saw that too in some of the numbers that came out.
Yeah, many months ago, we were noticing that BlackRock was not investing in oil.
You mean, yeah.
As far as lending.
Yeah, I mean, I said it in a little funky way. I'm sure that, I mean, it's such a big organization that I'm sure they had some stuff, but if you would have listened to any of the calls from BlackRock, all they cared about was ENG and moving to renewables. And there wasn't as much of a discussion of what that meant. It was much more oriented towards what classically is thought of as renewables, which is away from nat gas, which is not renewable, but is a part of getting a cleaner energy fix, so to speak. So they weren't really talking about, can we carbon sequester, which is now more what's being talked about. I mean, he's backed off so hard on that in the last 2 quarters on the earnings call, but 100% in general, CapEx went to almost, I mean, it went very, very low because, you had a $30 oil price and you couldn't even store it at that point. It was so crazy what was happening as a dynamic in just as COVID hit. And then shortly after that, because it was unclear the pace at which the government would reopen, you didn't have a lot of money going into this sector. Additionally, in general, ESG has had that net impact to the sector, so it's more private capital versus public capital in some ways, but we shall see, now there's just so much money being made out of the raw material itself. I don't even know if these guys need to come to market at all. They just have so much cash,
Right.
That's why he's saying like their break even is now $44 because, they have the cash to just do it. I think, I mean, it's just crazy what's going on in field.
You're saying by paying down debt reduces their overhead.
Yeah.
Okay.
Interest expense is lower for them than it was. But I don't think that's the way they're necessarily looking at. I mean, it is, because when you do a project, you still have to take in your cost of capital. So yeah.
Okay. And
that's how I'm thinking about it. I could be wrong. There could be other people that are thinking about it differently. I'm still trying to digest what they just said on the call. So I will give you that.
Well, and again, that market's inverted. So your nearby month is higher than your
farther out. Yeah, it's still, yeah, exactly.
So they could still hedge it at a great profit, but
yeah. If their break even is 44, then the back part of the curve is nowhere near 44. So there's beautiful profits to be made for that industry for the foreseeable, like, from a trader's perspective, like the foreseeable future is 1 month. So but from more of an investor's perspective, even in the next year, you should be okay for pretty much the entire energy complex to do fine. And quite frankly, if you think about it, if we get even energy prices just trading flat to slightly down, these guys will all still make a ton of money and inflation goes down because of the way that number is, you know what I mean? Inflation isn't just the price is high. Inflation is the price is high and not stable in this direction, in the upward direction.
Right. Okay, got it. Quickly, Amazon. So you just didn't like it mainly because of advertising?
No. They really just didn't make money. I don't know. I mean, they really didn't make money. It wasn't a good quarter. I don't know another way to say it. Like, I don't, everything is always relative to street expectations. And yes, they did have top line growth coming from AWS, but they did not sell more products. That's a lie. That's a bold-faced lie. Do you know what I'm saying? They lost money in every piece of their business that wasn't AWS. And the reason that it kind of looks like the ad spending is making money is because they separate that from the sale of products. So if you think about it, Amazon's a platform. And okay, so the only legit part of their retail business that I think you could say is making money is the grocery stores. I'll give you that all day long, okay? Because that's just true across all grocery stores right now, because every American has basically reconfigured their budgeting to do a little bit more on food than on all the other junkola that they would buy, okay? So the grocery business is legit growing. They've got some objectives there that are actually pretty cool, but it's just small relative to the retailer itself. And so the way that the breaking out, I am not a fan of this breaking out of the ad business, even though at the same time, it's good because you can see it better as an analyst. It's bad to the extent that it ends up getting these one-liners that are a little bit cockamamie in the news items. And that is this: They are a platform. They make money off both the person that posts something on the platform and they take a cut of whatever's sold. So the ad part is them taking a bigger, charging the person who's coming on more because they're paying for other specialty services, right? So that's what ad revenue actually is. It's not like product. I mean, it is also, in fairness, the Prime business. Sorry, it is also like, is it also, because it's kind of got a mixture of stuff in that number, because it is also the money that they're making off of product placements in the Amazon, what you call it? You know how like you watch the shows on Amazon Prime?
Mhm.
You know, so some of it is that too, but it's a little bit of a mixed bag what precisely that is. That's my point. You can't fully divorce it from the other stuff that's going on in the platform.
Okay, so if I'm an Amazon reseller, they're charging me for advertising, right?
Yes. So think of it this way. If I'm like Procter and Gamble, not your everyday kid that's just like really a badass doing some kind of like, I'm going to put this from Alibaba on whatever, the small guys. So yeah, they're getting charged more for sure. That's part of what's going on, right? But it's also like Procter and Gamble's coming on board. I'm going to do something, but also use like product placements in trying to think of what, like, I'm trying to think about what I watch on Amazon. Some show that Amazon does. I don't know. Do you know what I mean? So it's like, it's a little bit of a yeah, hopefully that made sense. So some people are comparing it directly to Netflix and they shouldn't, because it's not correct. That's not what that business is, in other words.
Gotcha.
Like with Netflix, if I'm Procter and Gamble and I go to Netflix and say I would like to place random like Procter and Gamble products in all of your films, what do you charge me for that? That's like comparable to other things that exist, period, within advertising, with the exception of Google, which is a little bit of a different animal altogether, right? That's not precisely what that business is.
Gotcha. Okay. I mean, it looks to us like, I mean, yeah, we've had a great rally, but we're very near a near-term top. So if Amazon would be a good put position,
I would
maybe
just
at the
like, it
end of the
usually
day
takes
today.
about, I totally interrupted you. I apologize. Go ahead, David. What are you about?
Maybe at the end of the day today.
Okay, so this is where I feel like you and Richard are just awesome, because like I've got a weird memory for Amazon, unfortunately, because I've been in and out of this a bit. And I remember nail biting it a little bit, like white knuckling it a little bit. It seems to me like Amazon can sometimes rally or stay stable for about a week to 2 weeks before it starts to make its way downwards. So I'm gonna actually just chill out until next week. The other thing with next week that's a little bit of a funky thing is that you just don't have that much economic news. So it's really going to be whoever reports earnings. And, the market has just shown a desire to do something that is completely divorced from whether or not a company's making money. So I kind of want to see if there's a better entry. So I would totally defer to the chartists on this. But as soon as that thing starts to trend downwards, there is definitely a reason to buy puts on it.
Cool. Yeah, I like that. Okay, May. Any other questions?
By the way, if you and Richard see something cool on it, but I'm scared mostly.
No, if you're seeing something in the earnings that is not kosher, then
yeah, it's not. And I know everybody's going to come out this week. So I know I'll be like the only girl saying these nasty things about poor Amazon, but like, it's true. I don't like it. I don't know. It's a 40% drag, guys. It's a 40% drag. No one else has that. Microsoft doesn't have that. Google doesn't have that. 40% drag.
you mean the retailers.
Yeah. Ouch, right?
Right. And that's 75% of their business. Is that right?
It's the majority of the revenues, but yeah, I think I have to double check now that the new numbers have come out, but I think last quarter was like 75% of, maybe even more, of the revenues. And then you have to think that like headcount, staffing costs that's like a much more specific version. Like I don't know what percentage of the cost it is. Let me just say it that way, but you can kind of see how things lay out.
Okay. Cool. Thank you.
Any other questions? All right, I'll go ahead and stop it there. Have an awesome weekend, guys.
TGIF me.
Thank you. Y'all have a great weekend.